This lesson on Fibonacci is related to support and resistance zones. So I'll explain first the concept of Fibonacci and then continue on the chart to show some examples of Fibonacci levels in trading. Fibonacci retracement levels are used to identify potential in the market. You might be thinking there are no other ways to identify support and resistance zones, which are very important in trading. However, another way that's used to identify support and resistance levels is the Fibonacci analysis. Traders identify support and resistance levels using a series of numbers. And these numbers were developed many centuries ago by an Italian mathematician named Leonardo da Pisa. The Fibonacci numbers start from 0 and they continue by summing the previous two numbers in the series. So 0 plus 1 equals 1, 1 plus 2 equals 3, 3 plus 2 equals 5, 5 plus 3 equals 8, and so on. Now these numbers get very long, so we don't use them in trading. Instead, the ratio, or the difference between the numbers in the series, is what's used. These series of numbers are known as Fibonacci ratios, or Fibonacci retracement levels. The numbers are used to identify support and resistance levels in Forex. The most popular levels used in trading are 23.6%, 38.2%, and 61.8%. Note, however, that there are other levels which can be used in trading, like 70.7%, 78.6%, 88.6%, and more. Now, Fibonacci levels act as price rejection levels because they can indicate the potential change momentum of the market, which allows you to either exit or enter a trade. Drawing Fibonacci levels on a chart is really easy. So let's start by showing examples of Fibonacci levels in trading. First, launch the MetaTrader 4. The Fibonacci retracement tool is already added by default in the toolbar, but if it doesn't appear, just go to the toolbar and click Customize. Then you can customize the tools by inserting and removing whatever you want. Before I start drawing the Fibonacci levels, it's really important to have the periods or the horizontal white lines which are shown on the chart. So go to the chart and right-click it with your mouse. Choose Properties and see if the period separators option is checked or unchecked. Make sure to enable it by ticking that option. The period separators would look very similar to my chart. Now, let's grab the Fibonacci retracement tools and find the highest wick and the lowest wick of that period. Okay, if there's an uptrend in that period, you should start drawing the levels from the lowest wick to the highest wick. In a downtrend, you should draw the levels starting from the highest wick to the lowest wick in that period. So in my chart, I'm drawing the levels starting from the highest wick at the top, which is highlighted with a 100.0 level. Also, placing the Fibonacci levels to the lowest wick of that period, which in this example is the 0.0 level. So when you draw the Fibonacci levels, always make sure to draw them on a closed period. All right, in my example, I've drawn the Fibonacci levels not in the last period, but the previously closed period. And the reason is that because this current period isn't yet closed, well, I don't want to know if the price will go even higher or lower. You always draw Fibonacci levels in a closed period. So after I drew the Fibonacci levels, we can see that support and resistance zones are here. Fibonacci levels, besides the support and resistance levels, are also used to set your stop loss and take profit levels. For example, when you trade at just one level, then you can adjust it to the next Fibonacci level and set it as the take profit number 2. You can add other levels to the Fibonacci by double-clicking on the red falling line and choosing Properties. Then go to Levels, and from there you can add other Fibonacci levels or delete the current ones. You can also customize the colors of the levels and adjust the width of the lines. Okay, now back to these levels. As you can see, the 100.0 level is the highest price of the closed period. Well, just below the highest wick, we have the close of the candlestick. So we can highlight that as a resistance zone. If you would open a sell order near the resistance zone. You could use Fibonacci levels to monitor the movement of the market for a potential change of the market's direction against you. The level 38.2 shows a resistance zone that's been formed after the price formed the support zone at 0.0 level, then moved up for some pips until it reached the 38.2 level by creating a resistance zone. Then the price moved down some pips by creating a support zone at the 23.6 level. The price then broke the resistance zone at 38.2 level by testing the major resistance zone at 1.08596. So as you can see, the wick of the candle has also tested the 100.0 level. But the price started to fall by testing the 38.2 level. Beside the Fibonacci levels, in the previous lesson I explained market patterns in Forex. So this is an example of a market pattern. A double top pattern has started to form with a top that acts as a resistance zone and a neckline at 0.0 level that acts as a support zone. So this is how Fibonacci works in the Forex market. These levels act as support and resistance zones, and you can trade these zones by placing your stop loss, your take profit, or making an entry or an exit from your position. Fibonacci levels are effective mostly on higher time frames, such as 1 hour or 4 hours, even daily. And Fibonacci levels are also effective on lower time frames. But because of the high volatility in the market, it's more unpredictable and unstable in lower time frames. That's the end of this lesson, which covered the Fibonacci level. So now let's head to the next lesson.